Cass Business School, welcome to the launch of The World is Upside Down by Dr. Jerome Booth. I'd like to introduce first Professor Paul Palmer of Cass Business School.
Well, good afternoon, evening everybody. Is my voice going to carry on back here? Yeah. Good. Well, just to do the usual thing. First off, if the fire alarm does go off, it's genuine. So if you could follow me in an orderly queue, straight down the steps and out to the front. But I've now covered the health and safety requirement, so that's now done, and all the rest of it. And to correct you, Professor Booth, maybe because I signed his paper. I
do want to devalue.
And like all great professors, he's actually written a cracking book, because I actually saw the proofs of this before it.
And you can understand it.
I just want to say a couple of words, particularly given that we have Lord Lawson present and Jerome. Some of you, first of all, very welcome to Cass Business School. To look at its proper title, the Sir John Cass Business School. And a couple of people have asked me who was Sir John Cass, why the name and all the rest of it. Very, very briefly, you'll see how this then links back to this book. Give me the license for 2 minutes. Right, Sir John Cass was Sheriff of the City of London at the time of James II. He was actually known as Honest Sir John, mainly because it exposed Samuel Pepys, the diarist, for corruption of selling emissions in the Navy. And one of the interesting things about Sir John Cass is his death. He died in quite mysterious circumstances. Some people would say he was murdered, others say other things happened. But he died and he left a substantial fortune, which to this day, the foundation is still worth in excess of £500 million. Right? But he left his substantial fortune to charity, to what we would call philanthropy. And the reason why I wanted to bring these two themes together is that, of course, there was no income tax paid in those days. But if he had, could you imagine what the gift then? And that was the link to Lord Lawson, because, of course, how he made his money, he invested in a couple of little companies. One was called the East India Company, and the other one was called the Hudson Bay Company. And I know somebody here said that they bought some land a while ago. He owned a little plot of land called Hackney as well, which was his market garden. But he established his fortune, in philanthropic terms. Because I wanted to use the expression that, of course, you've got to make money before you can give money away. And the whole point, very much of Jerome's book, I don't think it's going to tell you how to make money. They might tell you how not to lose money, from what I read it. Because, of course, don't take it the wrong way here, but generally speaking, usually after a journalist has told you what to buy, it's usually
there you go.
Don't buy.
I'd never trust that.
But I wanted to bring together the theme of saying that emerging markets have been around a few hundred years. They often get forgotten about, but that's where fortunes are made. And then once you've made your fortune, then as Lord Lawson is, as an outstanding Chancellor of the 20th century, then of course you should actually give the money away at the end. Because the best way to be remembered is to have the name given to a business school, a university college, or whatever. So there was the plug for the university there as well. I hope I come here to speak though. Over to you there.
Thank you. We're now going to ask Jerome to outline the main arguments in his book before we go to a panel discussion with our distinguished panel. Jerome.
Thank you, Lynn. And I was told by Lynn I had to start with dead bodies. So this is something I wrote down in 2011. And it was really to illustrate denial as one of the 5 stages of grief. And to a certain extent, of course, we're still in denial. So we discovered that if you look at public plus private sector debt in the UK, its percentage of GDP is still about 500%. After we beat Napoleon, it was maybe 240%, and it took us most of the century to pay that off. This is not a problem that's going to go away in a couple of years. So we have, if you like, a dead body, and it's rather large, and it's making a terrible mess. We are trying to do something about it, but we know it's going to take a long time, and we're arguing a little bit about how much we need to clear up. Then, of course, in the Eurozone, they have a dead body as well. It's not in the middle, in the German part of the kitchen floor is very clean. It's all around the edges. And by the way, they have plenty of cleaning equipment, and they can easily clean up everybody's mess, but they want to make the point that it's no good just giving the same old promises again. And they're not going to clear it up unless there are proper rules and strong institutions to stop this sort of concentration of dead bodies in the southern part of Europe reoccurring. And this is creating huge, great consternation. So they've agreed in their wisdom to get a sheet and put the sheet over the body. And this is a great claim that this is obviously a very sensible way to cope with the problem. Unfortunately, the blood is seeping and now getting into the shoe leather, and it's getting a bit sticky. So let's have a bigger sheet, a bigger one. So that's what's going on in Europe, and I would say it's still going on. In the United States, in comparison, they've taken the dead body, they've put it in a chair, given it a cup of coffee, and they're trying to have a conversation. The denial there is even more amazing. A lot of what the book is about, it isn't just about finance theory or how to invest, it's actually about prejudice. It's about the way we see the world. Earlier I remember having lunch with Lawson, and he said, oh, it's really 2 books. And actually it's even more. And I felt determined that I should actually get these different strands woven into one book. Because it is a number of things, and I felt you need to come with all these different arguments, because it is about prejudice. What I'm basically saying is that finance theory has all sorts of assumptions in models and limits. But the practical extent of those limits means that a lot of finance theory is just not usable. As Milton Friedman once said, if you have a theory which neither has realistic assumptions nor can predict the future, then it's perfectly useless. And a lot of finance theory, frankly, falls into that category. I read with horror one of the CFA manuals where it said that looking at the CAPM model, well, of course, it doesn't work in practice, but it's well grounded in theory. And of course, the theory, which was based on Fisher-Black's equations, was disproved as a circular argument by Richard Roll in 1977. So obviously, things haven't quite caught up. In order to set the scene, I start with a discussion of globalization in its trying to really narrow down on some economic aspects, and then I've put in a history of emerging debt, partly because I had several years of people saying, "Oh, that's very interesting. Where can I read about that?" And I didn't know of any. There are histories of emerging debt, but not histories that I agree with. So maybe it's a very partial history, but it is a history from a practitioner. And I suppose that reflects a lot of the book. I had lots of people saying to me I should write a book. And in fact, I had one person who came up to me and apologised for not reading the book, which I said under the circumstances was quite understandable. So eventually that sort of impulse, it made me go and write one. The book continues with an analysis of the macroeconomic situation building up to 2008, which I think is intrinsically not just about regulatory failure. And in the bank regulators' favour, I would say that regulating banks is much more difficult today than it was under the partnership structure. But it's a function of poor regulatory oversight. It's also a function of a huge move of savings from the emerging markets post the Asian crisis, which created this huge imbalance in the global economy, pushing down yield curves in the developed world and creating an artificial sense of risk, which led to huge leverage and these huge great bubbles. So I have to set that background. And then we get on to the meat of the hatchet job, which is on economics and finance. And a whole chapter just to risk. Risk is a 4-letter word. And it means lots of different things to different people. There is a big difference between volatility and risk. We seem to live sometimes in a world where we can't measure it, it doesn't exist. That seems to be the official line. Risk, of course, is not additive. It's different for different people. People have different liabilities, have different information. It's certainly much more complex than the simple measure, past measure of volatility. For most people, certainly those who aren't day traders and have a longer time horizon, and certainly for people managing their own money as opposed to other people's, they typically would be worrying more about large permanent loss than a bit of volatility. And yet that doesn't really come into our language. There is a quote by William Buter, I haven't got it verbatim, but there's a wonderful quote he says of something like this. He says, "This is perfectly obvious to anybody who hasn't got a postgraduate degree from Anglo-Saxon University in economics." And I think we have, if you like, as a discipline, we have rather got away from some of the basic understanding. And what I was trying to do, I suppose, in my own humble way, was really following Keynes's footsteps. I read the general theory as a 80% really trying to, if you like, destroy some of the existing economic theories and then replace it with a very simple idea. And what I'm trying to do in my book is say, there's nothing wrong in theory with saying all these assumptions. A lot of finance theory in theory is correct, but the practical application of it is wrong and unfit, and in fact has created distortion in asset allocation on a global scale. And that affects millions of people's lives. And it's got to change. It is wrong. And it's not good for investors. It's not good for emerging markets either. It's not good for creating greater systemic risk. And that's the central, if you like, motive of what I'm trying to do. So risk is, different from volatility. It's also different from uncertainty. There's a huge range of different understandings of what the word means. And then also talk about other factors in the market, other things that I think are overlooked. I talk about the way asset allocation is done and how that might be different. I talk about the structure of an investor base being important. I remember at Ashmore when we had the 08 crisis, which was really a crisis for us, not of fundamental macroeconomics as in 94 or 98. It was much less worrying in that sense. There wasn't any real risk of a major fundamental contagion in the way there was in those earlier crises, because the investor base was so much more local in two emerging markets and wasn't so, the countries weren't anything like as vulnerable. But what was the case was that liquidity could suddenly dry up. So why was that? I remember my son, who's sitting there somewhere, once when he was studying economics, sent me an article about the Thai crisis, saying that that was the Thai crisis, saying that the Thai crisis wasn't predicted, and the rationale for this, according to this academic, was that the spreads only burst out at the last minute. And I was thinking, well, that's wrong, because the IMF was very clear about its warnings. I remember warning investors 6 months before the crisis, and of course, Soros had a massive, very public, speculative attack, which was only prevented from fruition by Malaysian central bank and others actually coming to the rescue. So why would an academic be writing this? Well, they're writing it because what they're describing is not about suddenly new information in a simplistic way. It's because people's models of the world have moved. And so I develop in the book, amongst other things, a theory about this. The idea is that on one hand, you have people that, if you like, get it, that understand there's a balance payments crisis coming. And on the other hand, you have people that don't get it, and they see an arbitrage opportunity. They see spreads on, for their mind, risk-free investments increasing, so they just buy more, and then the spread goes down. So the spread remains low as this process of education, or eureka, if you like, on an individual basis being repeated many times, spreads. But what you end up with is then a more and more and more homogeneous investor base. And that itself creates systemic risk. I go on to talk about how, if you like, that is one of my triple cocktail of factors which can cause systemic crisis. A homogeneous investor base. A misunderstanding of risk which might suddenly change is the second, which is also obviously related. And thirdly, leverage, of course, at the economy or at the instrument level. And we should be thinking about, sudden risk in terms of those terms. We should be thinking about issues like, I don't know whether Andy Haldane is here, but he certainly was going to come, who've been writing about this in the Bank of England. We should be thinking about things like network theory. We should be trying to map, who owns what. The Brazilian central bank has a very good idea of who owns what securities in Brazil, and they can intervene in the appropriate time, very quickly, in exactly the right place by the right quantum. To think that the US government or regulatory structure could do that is just unthinkable. I spent about 5 or 10 minutes just explaining the concept to a regulator once in the United States, because I couldn't get their head around the idea that any regulator could possibly know who holds what within the US financial system. So we have a lot of policy prescriptions falling out of this. So I talk a lot about this. I talk about the structure of investment. I then have a whole sort of, if you like, checklist for the investor. What I'm doing is saying, there's problems with finance theory. The great thing about finance theory is it's a prod. It's your substitute for thinking. And what I'm saying is, check your assumptions. It may well be that it's not a good proxy, and you should therefore do the difficult thing, which is thinking in detail about the various different assumptions and methodologies that we're using. So I've got a checklist for investors, and then I have a chapter which is really for the regulator. Both some sections on, these are just, I'm getting to the point of the book where it's sort of more checklists, but it's lessons for the regulators in emerging markets, but also in developed countries, covering a range of things I've discussed. And then the consequences for the investor of those regulatory changes. So I'm trying to cover a range of things, but in the process we do come across things like pension reform in the UK, not just emerging markets. It is trying to be, a broad lesson, and I think, another central thing about it is and there's a whole chapter on this as well, is core periphery idea, the core periphery disease, as I call it, this deep-seated meme or intellectual virus, the idea that whatever happens in the developed world, affects the emerging, but doesn't normally affect the other way around. A very early example of this was after 08, and I can't remember the year exactly. There was an IMF report answering the question, if there's another, say, crisis in Greece, how much money might leave emerging markets? And you get the same sort of reports today. And they come up with this answer, $15 billion. Sounds a lot of money. Core periphery disease is not asking the question the other way around. Because once you start asking the question the other way around, and you realise that central banks and sovereign wealth funds in emerging markets hold about 100 times that amount, maybe 11 or 12 trillion dollars in so-called liquid European and US government debt alone, stuff they could sell like that, in theory. Of course they won't, because there'll be a liquidity crisis, a currency crisis, in theory. Then you realise that the shoe's on the other foot. If you then look back in history at other financial crises, you look at what actually happened in '71. It's the creditor central banks that call the shots, not the US. And so a little bit of rethinking the shape of the world involves who has really got bargaining power, not succumbing to the old bamboozlement of the status quo attitude that we're important and everything else isn't. Now, I can say this, I'll be saying this probably for the next 30 years, and there will still be people who won't believe me. Why? Because people believe what they want to believe, because prejudice is a massively resilient feature. And in fact, we love our prejudices. It becomes it's part of our, if you like, identification. It's part of our badge to have certain things. And so these ideas will be poo-pooed, I'm absolutely sure of it. But that's great for investors, because it means that there's going to be that arbitrage for the rest of our lives. All I can hope for is that we can erode it a little bit faster, because that is going to be good for the welfare of the human race. Thank you very much.
Thank you, Jerome. Thank you, Jerome. Ladies and gentlemen, we've got a fabulous panel here today to discuss emerging markets. We'll have a panel discussion, and do put your hand up. Jackie Balchin, who's from New Sparta, Jerome's private office, who put this event together, is with a mic, along with Claire Malloy, of course, from Professor Palmer's office. If it wasn't for Jackie and Claire, we wouldn't be here. So thank you to Jackie. Jackie's got the mic. The panel, ladies and gentlemen, along with Jerome, is Professor Gulnur Muradoglu, Turkish national, who I know has been a professor here at Cass, my alma mater, Warwick, at Manchester, and I think now you're at QMC, in John Cass country, as it were. We've got to my left, though not politically, I think, Gerard Lyons, who of course found fame as the chief economist of Standard Chartered, obviously the Western Bank, or one of the Western banks most heavily invested in emerging markets, now plying his trade as economic advisor to a bloke called Boris Johnson, also a Fulham fan, so we're very happy that he's managed to get out there this morning in deep depression. To my right, of course, we have Lord Lawson, Nigel Lawson, in many people's eyes, certainly not, if not the most successful, then one of the most successful chancellors of the 20th century, now a leading member of the Economic Affairs Committee in the House of Lords, the Parliamentary Banking Commission, and often on our airwaves speaking out, speaking truth to power, I think we may say. And then, of course, Jerome. I'm going to start with you, Lord Lawson, if I may. You've given Jerome's book a nice endorsement. What parts of it would you disagree with?
It's a good question. I gave Jerome's book an endorsement, not because he's a friend of mine, which he is, but because it's a bloody good book. And everybody should read it. And it was clear to those of you who've not come across Jerome before, it was clear from his introductory remarks, he's a one-off. I don't know anybody else quite like him. I don't know anybody else, but apart from the fact that he's also a double bass player, and I don't know many double bass players. But anyhow, he was a practitioner in this area and did extremely well. He had very good judgment, but as well as being a practical man, he understands the theory, and perhaps equally important, he understands human nature. And all these understandings come together in this book, and that is quite unusual. You asked me what I disagree with. Not a lot. I think, however, that in his enthusiasm for the emerging world, he is a little bit too down on the developed world. I think that the fact, which I don't think he mentions anywhere, that the level of corruption, although not zero, is less in the developed world, is actually a plus point. I think that also we can cope. He is obsessed with the high level of indebtedness. I think that provided we run our economies in the Western world sensibly, we can cope with this high level of indebtedness. I think also that he doesn't give enough attention to one of the few undoubtedly good things about the world as we know it, one of the few areas in which there is genuine progress. Being a conservative on the whole, I am under no illusions about human nature. But nevertheless, the idea that we get better is for the birds. We don't. We stay the same, and we're lucky we don't get worse. But there is one area in which there's progress, and that's technology. The progress of technology has transformed the world over the past 100 years, and I have no doubt that it is likely to transform the world in ways that many of us can't imagine over the next 100 years. And that is going to be a huge plus. So I think that he is fundamentally right in that there is an enormous and irrational prejudice against the emerging world, particularly in the allocation of investment portfolios. But I think he is a little bit too gloomy. I hope he is anyway. A little bit too gloomy about the developed world.
Thank you, Lord Lawson. Professor Muradoglu, do you think that the Western world suffers from irrational and unjust prejudice towards asset allocation in emerging markets, as Lord Lawson suggests?
I've read an earlier version of the book about 2 years ago when Jerome was very young. I met Jerome through Paul, I don't know how many years ago, but he's kindly come and talked to my students of the class, and that we met. The students enjoyed his talks, and so did I. And similarly, I enjoyed it in a similar manner. Because what he calls as prejudice in behavioral finance is something that's called home bias, familiar bias. And that bias is very universal. We're all more comfortable with the familiar and less comfortable with the unfamiliar. And I think what Jerome has done with the book and with his practice is to break that ice and make the unfamiliar the familiar and break that fear. And I think in this book again, it's not only making the unfamiliar investment opportunity emerging markets a possible asset class, but also similarly having some kind of a hybrid attitude towards theory and practice at the same time. Again, when you look at the two worlds in finance, the academia and the practice of finance, sometimes they have prejudice against each other as well. And they're not in the same home, they're not familiar with each other. But the book itself, in its tone and in its approach, has broken that ice as well. He's very well founded in theory, and he uses the theory in his storytelling about practice. And therefore, he can touch upon the many aspects of practice, including regulation, including the banking systems, but including the asset allocation decision itself.
Gerard, emerging markets, of course, as Jerome says, 85% of the world's population, 4/5 of foreign exchange reserves, pretty amazing numbers. 50% of nominal GDP, a lot more of PPP GDP, as us economists say. Yet only 15% of all assets and equities are in emerging markets, and less than 10% of all assets in bond markets are in emerging markets. Is our future investing in emerging markets or in the European Union?
Okay. Well, good evening. It's a pleasure to be here. I thought the book was a fantastic book. I should come back on one thing. In my role with Boris, it's non-political, so I am, in theory, non-political.
You look after yourself, Jerry.
Very good. So, yeah, obviously it's all personal comments this evening. In terms of, is the future in Europe or emerging economies? Actually, I think Lord Lawson touched on something that I think is relevant to this question. I think the issues that Jerome touches on in the book, in terms of, if we can think of the world economy as a cake, shall we say, the issues that he touches on in the book will make the global economic cake much, much, much bigger. And in that respect, investors in the West should have more of their assets in emerging economies because they're under-invested in now. But at the same time, the West's share of that cake, while the relative slice of it will be smaller, there will be a lot more cake than before. So it's not a case of writing off the West. You still have to be invested in the West. And indeed, that's why I think the West shouldn't fear what's happening in terms of the global economy. In fact, there's many aspects in terms of the global economy that still favour the West. Hard power, soft power. But in the book, it very much talks about how, and I think it's right, and I agree with it fully, that economic and financial power is changing and shifting towards the emerging economies. I think there is a danger in economics, and the book puts the boot in on macroeconomics, but probably doesn't put the boot in enough in some respects. There is a problem with economics, and in some respects with finance, of what I would call a status quo bias. You actually see it in terms of the debate about the world economy now. The same people who were optimistic about the world economy before the crisis are the same, or about the Western world before the crisis, are very much the same people who are very pessimistic about it now. And I think in finance, there's also a status quo bias in terms of where people put their money. And the book does touch on this in some respects. The challenge for the emerging economy or the emerging economies, and we're using a very general term here, is again something touched on in the book, which is relevant to your question, Leo. If we're to see more investment in emerging economies, if we're to see emerging economies realise their potential, then they need to develop the whole institutional framework. They need to deepen and broaden their capital markets, and they need to make their markets receptive to investment from the West. What's clear is that emerging economies have not really developed their capital markets as much as they should have done. And that's both necessary if they're to move from export-led to domestically driven growth, and it's also necessary if they're to realise their full potential, and if we're in the West to invest more of our money there.
Just before we ask Jerome to respond to the comments, Lord Lawson would like to add.
Yeah, I'd like to add one thing which supports Jerome's fundamental thesis. I am a very old man, I've been around for a very long time. The thing that has struck me most is that there are really two models for economic organization. There are varieties of each. Whereas there is the socialist command economy or the capitalist market economy. and the first doesn't work at all. The second doesn't work perfectly, but it does work. And the great change that has occurred during my lifetime is the countries in the developing world who have moved from the first model, from the socialist command to the capitalist model. Of course, in China it's a different kind of capitalism, in Japan it's a different kind of capitalism. They were the first of the emerging countries ready to emerge a long time ago. I remember watching that. And again, the market is different, the capitalism is different, but it is recognizing the essential thing. And once you get the right model, right which of those two, you are going to catch up. And it's only a question of how long it's going to take you. And that depends on a lot of things. That depends in particular on the nature of governance. And there are some countries, many countries in Africa still today, where the nature of governance is so bad that it's very difficult for them to make any progress at all. Provided you have a reasonable level of governance, then once you move from the wrong model to the right model, you are going to catch up. And that is what has been the story of the developing world. And I think that Jerome is absolutely right that people haven't taken this on board sufficiently. Pension funds and other investing institutions. To say, once they're caught up, it may well be that they don't do as well as United Kingdom, United States, or continental Europe. Who knows? But the point is they haven't got there yet. And we are now in the phase of catch-up. And that is why, despite all the difficulties there are, despite the very bumpy road that is going to be, despite the unattractive demography of China, which is in many ways the most impressive of the major developing countries. South Korea is perhaps even more impressive, but it's a much smaller country. Although there are these problems and these bumps in the road, I have no doubt that the process of catch-up is going to take place. And this is perhaps the single most important point when you're looking at asset allocation.
That's right. Actually, it's just one interesting thing I learned last week. Last year, China had 40 cabinet meetings, and 30 of them were about reforming their economy. And I think we underestimate the extent to which some economies are actually not only addressing the issues, but actually taking them one step further.
And we're a great trading nation, of course, by reputation, by history. Yet the UK, our combined trade with the big four emerging markets is less than our combined trade with Belgium.
Well,
shouldn't we have done more in the last 20 to 30 years to grab these opportunities?
I'm afraid
Germany's outstripping us here.
I'm afraid this country, there is a problem in this country. I don't want to talk too much. In the 50s and 60s, we had an obsession with the Empire and the Commonwealth. And we were trying to do all our trade with the Empire and the Commonwealth.
New Zealand
and we forgot about Europe, which was on our doorstep. And Europe was in the process of recovering from the war and going through a period of quite high growth as a result of the recovery from the devastation of the war. We have now moved into a position where we are obsessed with Europe and fail to realize that the biggest opportunities lie outside Europe. Our obsession with the European Union, Europe, is, in my judgment, extremely harmful to us. And I am not anti-European in any emotional or historical sense. Indeed, my home is in France. But this economic obsession with Europe, I think, is highly damaging.
Jerome, Professor Muradoglu, it's a familiarity thing. We're comfortable with what's familiar. Lord Lawson says you're being a bit tough on the West.
Well, I think on the first point, I think what I've tried to say is that with regards to our biases, which have been, we've learned a lot from behavioural finance, we should therefore be compensating for our biases in the way that we do asset allocation, and that's the next step. That's lacking. And I think, you know, in terms of being tough on the West, well, I am tough on the West, and I, you know, hope I'm wrong as well. But I am, I think, trying to look at risk scenarios specifically. And I think what my point is really is not that, you know, there isn't more corruption in emerging markets than in the West, but the point is that there is corruption everywhere. And you know, Enron was not an emerging market company, and you know, fraud happens, and you know, that's human nature. What I'm trying to say is not that emerging markets are somehow much less risky. I'm saying that risk is everywhere, and it's the perception of risk which is massively distorted.
But as a natural polemicist, and you're not the only natural polemicist on this panel, are we sometimes guilty of overstating our case in order to grab attention? I mean, do you really believe that 50% of your pension funds should be in emerging markets if you'll say 40 or 50?
I think it depends on your view of the shift in the global economy. And the answer is yes, I do. And you know, I think if one is sort of super bearish on Europe and the US, particularly if one is actually conservative and inclined towards debt as one's allocation, one should realise that the nature of financial repression is to rob, you know, savers.
Keeping real interest rates artificially low.
And you know, it may be a very loyal and patriotic thing to give part of your pension to the government. But I wouldn't do it on the basis, and it may make you feel good as well, but I wouldn't do it on the basis of sound optimal asset allocation. On that basis, I would want to look at you know, where out of the global opportunities that exist, I would be looking at income. There are two basic ways to value an entity, an economic entity. One is on replacement value, turned into Q, another is some seasonally adjusted measure of income. So if we look at the west coast of Ireland, which is full of, you know, lovely holiday second homes.
We've got two paddies on this panel,
We're about to be pushed off the edge. Okay, it's got absolutely lovely second homes, but as you know, they're all empty. The question is, do you value that by the replacement value, several billion, or the income stream from it? And I think we have a bias because of the nature of indices towards capital replacement. And I think what most investors want is actually, this is Andrew Smithers' book.
Sure.
What most investors want is future income. And the best measure of future income is past income, and the best measure of past income is GDP. So that's where you get to the 50% allocation. So I'm not saying, on the one hand, I'm just saying that's the neutral position. I'm not saying, I'm saying that's also the position that is probably closer to meeting your liabilities than 10% or 20%. Let's talk a little bit about liabilities. Well, if you are, particularly in an open economy like the UK, if you're paying into a pension fund today for an income stream later on, and bearing in mind that, you know, we do have a big debt, and there might be a bout of certainly negative real interest rates, but maybe even quite high inflation over the next 20 years in order to erode that debt, then what you really want is not, of course, a nominal amount of sterling or dollars, because that may be worth very little in 20 years. It may buy you, you know, hardly anything. What you want is the purchasing power. And it's, so one way to adjust is just say, well, we'll adjust for inflation. But actually a more accurate way is to think about the cause of inflation in a global marketplace, where maybe in 20 years, not only are 90% of cars in the global economy made in emerging markets, but they're also bought in emerging markets. And insofar as there's any global market for a thing such as a car, it will be set in emerging markets. And emerging markets are increasingly the price setters in global, not just commodity markets, they're already there, but in goods markets. So insofar as that is a view of history, then if you don't invest in those markets today, you're fundamentally going away from your liabilities. You're actually taking a gamble on your home country. So this is, you know, it's not as if, you know, home bias is just, you know, an interesting phenomenon. It's fundamentally increasing people's risk. And I think, you know, one can argue about whether it's 50 or 40, but it's not 10.
Fair enough. Please.
When you look back about 50, 60 years ago, about 10% of world trade is outside the US UK. Today, about 50% of world trade is in the emerging markets.
South.
Yes. So when you look at it, I mean, the one thing that it says is there is liquidity. So So you're not investing in an asset class that doesn't have it. In the beginning of 1990s, I was working in Turkey, and the Turkish stock market was new, and I had to work like a crisp to establish an adjusted price series to work on the market. So it was costly to retrieve information about the emerging markets. It's not anymore. So there are databases that collect and disseminate data in uniform manner about almost every emerging market that you can think of. And it's not, the information gathering is not as costly as it was 20, 30 years ago.
How believable is the information?
The information
As
is
believable as it is in the West?
provided.
Okay.
Well, it is as believable as the data in the West. Because if there is an error, it's usually in the same direction, and everyone knows that. So, and those adjustments are made usually by the data provider. So if there is a gap, then the gap is indicated, etc. So I think two of the reasons, one liquidity, the other one the information gathering, the cost of information gathering, are no longer an issue as they were 50 years ago. But I think the bias, the prejudice, the familiarity, whatever you say, that it's precipitated in our minds, that it's difficult, it's unreliable, we can't know, we can't see, etc. And that's one reason that's holding us back. So when you think about the ground errors that one can make, think about the collapse of Enron, and think about the legal situation in the US, where you can invest in your own pension. And there were quite a number of Enron employees whose incomes were coming from the same company. And when they lost the job, they were jobless and they didn't have a pension. It is a big risk. And it's an investment in one of the deepest markets in the world, the US.
Do you think the West is hypocritical? Do you think we stress overseas corruption more than we stress our own corruption as a media, as a political class, as academics?
I think it's not
Is
about...
our corruption just older, a bit more established, a bit smoother?
I don't think it's about how...
Sorry.
I don't think it's about how much you emphasize corruption, but I think it's more about seeing the investment opportunity. And if there is one, not missing it. So if there is one, obviously you shouldn't miss it.
Dr. Lyons, do you think... Sorry.
You keep on doing it.
I should take this.
Mr. Halligan, that's fine.
Jerry, do you think it's mad to put 50% of your pension fund in emerging markets?
Actually, I think Jerome answered that question himself in terms of your asset liability. But I think there is an issue here. You don't put 50% overnight if you're an average person. But in people, you don't expect individuals necessarily to have all of the expert knowledge. They rely on the experts in the financial industry. And I think there's a whole issue, there's two issues here that are touched on in the book. One is the trust relationship between private citizens and the financial industry. And second is the whole asset allocation within the private industry, or sorry, the financial industry itself. The book does actually sort of highlight many different things. There's a great quote on page 59, the computer displaced trust in many financial transactions, which I think goes to the heart of the issue. Then there's another classic quote on page 97, where Jerome talks about the Martian coming to Earth and investing. Before the financial crisis, this is remarkable, so good a statistic it might end up in the Sunday Telegraph one day. He said there were 12 AAA companies before the financial crisis, and there were 64,000 AAA rated structured products. That was pretty staggering. So I think to get to 50% takes time. It comes back, I come back to what I was saying earlier. You need to be able to absorb this as well. I think if you look over the last decade, only 4 emerging economies, and again the generalization when we say emerging economies, have really started to develop their local bond markets. China, South Korea, India and Brazil. And they're pretty small. So they need emerging economies need to be able to absorb the inflows to actually allow financial investors and the financial industry to have more confidence. At the same time, I think you need to have the whole change in the whole asset allocation process. So yeah, I think the world economy is going to boom in the next 20 odd years. I think emerging economies already starting to drive that process. The figures I like quoting are 32, 62, 72. They're not in the book, but I always like these figures. $32 trillion was the size of the world economy at the beginning of this century. $62 trillion was the size of the world economy. These are nominal figures. $62 trillion the day Lehman Brothers went bust. And $72 trillion was the size of the world economy at the beginning of last year. So despite the biggest financial crisis in 80 odd years, the world economic cake has got bigger and bigger. And I think that's a reflection of what's been touched on about GDP. And you only need to look at global companies as well. Where do we buy our stuff from? As people start to buy more things from more countries around the world, they become more familiar with it. 40 years ago, people wouldn't have expected everyone to want to buy Korean goods or Japanese goods. But when you actually start buying them and realise they actually start working, then you think, gosh, then that will make people more familiar.
Lord Lawson, Jerome talked not just about the allure of emerging markets, the returns and investment opportunities and so on, but also he touched on the push away from developed markets, our high indebtedness, our financial repression, the almost deliberate keeping of real interest rates that are negative, pushing pension fund holders into gilts that will by definition give a negative rate of return. If this isn't a deliberate policy by Western governments, then it's certainly one that they seem relatively happy with, and they don't seem to want to talk about it very much. Do you think financial commentators, academics, concerned, financially literate citizens should be upset about financial repression? Do you think we'll look back in decades to come and see it as an exploitation of our voters?
Well, you can speak for financial commentators. Yeah. I think that what happened was that we had the worst banking meltdown, certainly within living memory, and arguably it was the worst banking meltdown that there's ever been, worse even than what happened in the 1930s, where it didn't happen in this country at all. There was no banking meltdown in the United Kingdom in the 1930s. There was in the United States, which had a very different banking structure. And this led to a recession which was extremely difficult to handle. And the governments of the West didn't quite know how to handle it. They introduced these unusual measures. I think that they know that they have now, because as Gerard Lyons pointed out, we've recovered from that enormous recession. And I think they now know that they need to get out of it. But they don't quite know how to do it, because it's never happened before. It's never happened in their lifetime. They have no experience. And so they're a bit thrashing around. But I think they do know that they've got to come out of this can't continue. And we've got to get back to a more sensible level of interest rates. And indeed, I think they are aware that there is a danger which Jerome thinks is nigh on the certainty. I don't think it is, but there's certainly danger of a recrudescence of inflation in the West if they don't get back to a different form of monetary policy and get rid of the quantitative easing and unwind the quantitative easing. So I think there's got to happen. But there are other things which worry me more, and they are the fundamental weaknesses, some of which Jerome touched on in his book, fundamental weaknesses of the Western banking and financial system. And I'm more concerned that we should, it's very difficult to address those, but concerned about how we're going to get out of these ridiculously low level of interest rates.
And you want a full separation of investment and commercial banking?
Look, yes, but there is, I do want that, absolutely.
And you're probably the most senior politician in this country that applies
the Banking Commission, of which I was a member, accepted the figures I gave In other words, they accepted there was a problem, but they thought it could be solved by a ring fence. You didn't have to have complete separation. We were more sceptical. I never believed that at all. But as a commission, we decided, I think recently, that we should produce a unanimous report, because there was no way the government would take any notice of us unless we produced a unanimous report. And you don't want to do all that work if the government's not going to take any notice. And so the position we reached was that, okay, well, let's give the ring fence a chance, but if it doesn't work, then there's probably a review. If it doesn't work, then we go to complete separation.
So it's electrified.
So that was the electrification. And I don't believe it will work. I think that there is a fundamental problem with bringing the investment banking with its totally different culture into high street banking. There's also, I think that the Vickers model of corporate governance is a model which has never happened anywhere in the world. And I don't believe it is workable for a moment. And I don't know any senior banker privately who thinks this model of governance is workable. But I think there is even more fundamental problem. I mentioned how the only system that works is the capitalist market system. The capitalist market system has really two great drivers, in my opinion. It has the reward for creativity and the success for the entrepreneur who really has a great idea and really can do something. That is tremendously important, which doesn't happen in the States. But it also has the market discipline of the fear of failure. And if you remove that market discipline, which has been removed from the banking system, then the system doesn't work. Unless banks can be allowed to fail, the system doesn't work, and we're going to have this problem time and time again. And that is a fundamental point which has not been, I think, adequately addressed. And the separation of investment banking and commercial banking, which I believe is essential, is not merely because these are two totally different cultures. And if the commercial banking is infected by the risk-taking culture of investment banking, you know what happens. But not only are these two completely different cultures, but it will make the banks smaller than they were, and also the high street banks, if they are disembarrassed of all the investment banking, are in fact something which the regulators may be capable of regulating. But the universal bank, the regulators will never succeed in it. Never. And I'm sorry that Andy is not here. And it is foolish to think that you can. So I think that a more radical approach to the banking problem and the principal agent problem, incidentally, which is wrapped up with it, which Jerome writes very well about in his book, and is a very real problem. I think that we've got to address that, and it hasn't been addressed yet.
Forgive me, ladies and gentlemen, forgive me, Jerome. What does George Osborne say when you say this to him?
Very interesting.
Jerome.
It is very interesting. Well,
How comfortable are you that the British government, a third of the outstanding debt instruments of the British government are owned effectively by the Bank of England?
I'm not entirely comfortable with it. I can see, when you've got a crisis, there is a necessity to do something, and I see very much, starting with the US reaction to systemic banking failure on a really huge scale, and the lack of response in the normal way, which of course Lawson himself was in a position to intervene in the bank. That's what you normally do. You seize the bank, and that was not done in the United States by the government, and that was the failure of policy. So given that failure, I can understand quantitative easing as a response to systemic risk of the whole banking system. And that's what it is. It is not, and should not be interpreted, as it often is, as a way to somehow, pump prime the whole economy.
But it was 50 billion at the beginning, and now it's 375 billion. emergency measure may be justified to become a lifestyle
Well,
choice.
this is putting the blanket over the dead body and putting the blanket over the dead body keeps the flies away, it makes the job. But if you just leave it there and don't do anything else, that's the problem. And that's they've now put bigger and bigger blankets on. And the problem wasn't, if you like, the original reaction. It was the fact that that's now not being followed up by appropriate action. And I have to agree with Lord Lawson entirely about the need to separate banks. I do spend some time on this because not only are investment banks unregulated, or it's not possible to regulate them, but they're unmanageable as well, because the senior managers not only don't have the incentive to regulate, manage their companies, but they have no information. They can't see what people are doing, and so there's a whole, if you like, it doesn't go anything like the Banking Commission, doesn't go far enough in what needs to be done.
Well, we did go a bit further because we did try and address this. One of the things that we felt was that there was no real individual responsibility in banking. The top management could always say decisions were taken either collectively, so I wasn't responsible, or they were taken somewhere else. We didn't know what the traders were doing, or whatever it is. And so what has happened in when, rather belatedly, some banks have been discovered, the American authorities were rather more on the ball than our regulatory authorities were. But nevertheless, when it's been discovered that some appalling wrongdoing was taking place, what happens is the bank is fined. Well, that is no good. If the bank is,
it pays with bailout money.
If the bank is fined, if it's been bailed out, it pays with bailout money, otherwise it's shareholders' money. Either way, it's either the taxpayer who's innocent or the shareholders are innocent, who are paying the price. And the people who are responsible have no So we did introduce individual responsibility, that nobody can now say, if they're in a senior position in the bank, that they were not responsible. If they didn't know about it, it was their job to know about it, and they're responsible for not knowing
Is this not
about
so?
it. And we introduced, and this is quite contentious, even, which is completely new, that in the extreme case, a prison sentence can be imposed on an individual, not just a fine. So we did try and address the very problem which Jerome has quite correctly identified.
Where are you on Glass-Steagall these days, Gerard?
Actually, I've wrote about this in my book. Can I mention my book?
Please.
Actually, I've got a book coming out this summer, but I do mention the fact.
It's almost as good as this one.
But the reason for mentioning it here, apart from being able to plug it to you, is that I say the financial crisis, in my view, was caused by the 4 Gs: Glass-Steagall, Greenspan, governance, and greed. And I think Glass-Steagall, you can argue that Glass-Steagall didn't directly contribute to anything in the financial crisis. But as covered in the book, and as Lord Lawson touched on just a few minutes ago, I think the whole culture changed. And you're not bringing like to like together. What's interesting, the financial crisis here in the UK, the banks were very good at getting it called a financial crisis, or it was a banking crisis. And also I think the banks have been very good in recent years by saying, oh, any solution, you can't have that as a solution because that didn't cause the crisis. And that's one of the things for Glass-Steagall. Also size is another issue. You can't say size necessarily caused the crisis, but we're sat here in an economy where the financial sector is over 800% of GDP. Wow. We should all be concerned about that. So size...
That's 100% of the states, right?
Yeah, so size does implicitly come into it as well. So I think Glass-Steagall is an important issue. Governance as well. Greenspan, I think interest rates were kept too low. You see, Mark Carney has given some interesting speeches. I see Glenn Hogarth from the Bank of England here. I'm not sure if there's anyone else from the bank here in the room. But Carney, in both December in New York and in January in Davos, said basically rates have to stay low for long. Rates will then go up gradually, and then rates will peak at a low level. I agree with the first two of those. I think rates have to stay low for long because the economy is incredibly fragile. Rates, I think, have to go up gradually because private sector debt is still very high. But the issue about rates peaking at a low level, I am concerned about. If rates are to peak at a low level, then it means that macroprudential policy really has to work phenomenally well. Now, let's not forget that when Paul Tucker was Deputy Governor of the Bank of England, he was very concerned that macroprudential policy was taking the bank from areas of its comfort zone, monetary policy, into areas, basically fiscal policy and political issues. So the bank basically backed away, in my view, from calling for all the macroprudential measures it wanted. So if you say macroprudential policy isn't going to work, then it's inconceivable that interest rates peak at a low level here in the UK. And there's Bill White, who was at the BIS and is now doing some really good stuff at the OECD, has been writing about this. And I agree with him completely. He says that one of the lessons in the last 20 years, particularly from Greenspan, etc., was not that rates didn't fall in response to shocks. It's that when rates went back up, they didn't go back up high enough. And I think that's the key issue. Because pricing of risk, and one of the key things in this book that Jerome does really well is when you talk about uncertainty and risk. Because I think these issues get muddled up all the time, and you make it explicit and very clear in the book. And I think in terms of the crisis and in terms of monetary policy does have a big bearing on how the markets price for risk.
If anyone does dare to ask a question, do stick your hand in the air. Professor Muradoglu, let's move on if we may. Currency wars. One second. Do you want to come back on this?
Well, yeah.
Okay, go for it. Jack will give you mine. Thank you.
I think Oscar Wilde said, that in good society one always has the same opinions. And I agree with everything that's been said. We're spending most of this afternoon looking backwards at the crisis. I thought we were here to discuss emerging markets. I think what's valuable about this book, it pulls all the threads together and focuses on the emerging markets. And I'd like to ask Jerome a question, and probably to Gerard Lyons too, because of his background as Standard Chartered. I'm heavily involved now, having been a merchant banker with Africa. And I do see movement of funds and investors coming from east, west, and west-east, and all in the south. Although Turkey is now a major player in Africa. People are adventurous. We're sat here with this massive city of London, which controls so much of our lives, and I don't think it's sorted out yet. Meanwhile, we have very good skills in this country, in construction, in engineering. These people ought to be out working in the emerging markets. We don't have the tools. What I'd like to see is the section you wrote about the international financial institutions. They're out of date. They don't address the risks that really exist, which prevent our investors and our companies operating in Africa, Latin America, and in Asia. They don't do it. The export credit agencies which help are now moribund. We're not exporting anything, yet our companies do want to get involved. There's a huge job to be done in infrastructure. For goodness sakes, we've got the companies here. Has anybody thought about reforming the World Bank, the IFC, the Inter-American Development Bank, the Asian Development Bank, the African Development Bank? They're crammed full of economists. All the old skills, political risk experts, engineers, experts on agronomists, they're all gone. And what are they doing? They're doing balance of payments levy, which is the funds business, and they're not actually getting a basis dealing with the risks, including the risk of corruption, which I remember Lord Lawson addressing in his earlier days when we were trying to pass the anti-corruption legislation in this country. These are not being dealt with. And I think your book actually brings out these threads, and I'd like to see more attention paid as soft power. We could lead the Commonwealth, India and Brazil and South Africa and China to reform those institutions. Otherwise, the Chinese are going to take all the business because they don't have the same conditionality and they don't suffer from the hordes of economists that have taken over the World Bank.
Thank you.
I don't know what you
if we may, can Jerome just answer that, and then I'm going to ask you some questions. Jerome.
I mean, as you know, I worked for the Inter-American Development Bank and saw.
So it's your fault.
Well, it was my fault in the sense that I'm an economist, but I saw very much the process of getting rid of some of these key skills, which had been one of the great strengths of that particular institution. And I'm a big proponent of much greater infrastructure investment. In fact, the way I see the solution to the global imbalance, if you like, is to some extent a major effort of trillions of dollars to build infrastructure and real estate, for that matter, in emerging markets, because that's a way to absorb the trillions of excess savings reasonably fast, and to do so, which you end up with productive assets as well, which can increase productivity in the longer term. And if you look at a country like India, this is where the real bottlenecks are. They've built 4 roads, and that's it so far. And Brazil, for all its complaining about as I call it, the bad weather, quantitative easing, which is a bit like a spot of rain outside, and they should get their umbrella out and stop complaining. But the real problem is they need $1 trillion of investment in infrastructure, and actually the Chinese can help with that as well. But we should be there. I completely agree. I think the other, if we're on international institutions, and I spend rather more on this in the book, is that it'd be nice to have a real effort to reform the international monetary system. Oh, that's if you assume that we have one. There's been endless talk of this, and I'm very conscious that Peter Oppenheimer is in the room. But the international monetary system, has really demonstrated its huge weakness post-08, and we've had a lot of discussion about reform. But of course, there's a great lack of understanding of it. We have obviously Nigel Lawson, who's of the period of the Plaza Accord and all the rest of it. This is the era we need to get. We need some agreements. We need actually to get back to a sense that there is someone in charge of at least the architecture structure, and we're not doing that. And the result is that if we're not careful, we will actually have another big global international crisis. And we've got to address the issue of the international monetary system. We've got to do things, as I say in the book, we've got to start actually working out who owns what. We've got to start mapping the problems from a systemic risk point of view. That means we've got to start thinking in terms of network theory and all these sort of things, which, we just haven't done that. There's a lot more to do, and I think, having an IMF, which is just completely unrepresentative of the economic reality, with so little influence of the emerging markets, is just not good enough. I have great respect for the IMF, great respect for all it's done, but it needs to reinvent itself in a much more rigorous way than it's doing at the minute.
Professor Muradoglu, among the resurgent nations of the world, India, Brazil, Turkey, China, what is the reputation of the IMF now? Are we close to a situation where it's going to lose its consent? Do you think there's a danger that unless the Western world bucks up this ideas and has proper reform of voting rights, that the big emerging markets, with their dominance of reserves and increasingly of global trade, will set up their own system? Is there a danger we can have some kind of severance between the Western world and the emerging markets in terms of financial institutions?
Well, think about it this way. The IMF is a lender of last resort. So if you can't lend in any other form, then you go to IMF and you can lend through the IMF. So I think in today's world, with many emerging markets, including Turkey today, with many emerging markets, if they can lend from the international financial markets, if they can go to the market themselves, obviously there is no need for the IMF. Therefore, the role of IMF is changing over time. And the IMF and the World Bank were both involved this way or the other in the recent global financial crisis. Because I think the way that we look into the world is changing and will change even further. I've come across bank runs in Turkey, and being Turkish and having lived in different countries and having experienced different economic environments and working as a professor of finance, I think I'm liberal. But when Northern Rock got bankrupt, and there was a bank run, and I saw the queue on the street, I wouldn't believe it. I thought this could never ever happen in a deep economy as the UK, but it could happen in a smaller emerging market. So the way we understand the world is changing. So something that you would expect in an emerging market is happening in a very well-developed market, and it's happening on a big scale. So that's not the only bank that needs to be bailed out. We have to come up with a new regulation. So the regulation that we had before the 2008 crisis was made mainly following the 1929 crisis. And it was...
So we need a recasting, a new Bretton Woods.
Absolutely, because it was referring to a different world where the investment mechanisms were different, where the assets that one could invest were different, where the household and institutional investments were different. Today, about 70% of investments are made by institutions. Then I think it was about only 10-20% in 1920s that was made by institutions. So we need a new regulation that can regulate the environment, the financial environment that we're living in. And I think the differentiation between emerging versus developed markets is not as one would do 30 years ago.
Sure. Peter Oppenheimer. Sorry, Peter, I didn't catch you.
That's all right. Just want to say a couple of things. You put a question mark at the end of what I say and pretend it's present. First, as regards Northern Rock, I'm glad that's come up. That surely was an absolutely straightforward failure of regulation. A bank, a high street bank, which is what it was, has no business funding the majority of its lending activities by anything other than its customers' deposits. And they funded most of it by borrowing. The Bank of England should have stepped in and stopped them. One reason it didn't do so was, of course, nominally they weren't responsible for regulation at that time, then it moved to a separate authority. But it was the erosion, the corruption of modern central banking in that particular case that it's no good declaring the Bank of England independent if you don't let it regulate and it doesn't know what it should be doing as regulator. I would remind everybody that the decline in the Bank of England's behaviour there was quite recent. The last occasion on which a governor of the Bank of England used his eyebrow to sack the head of a commercial bank saying, "You mishandled, you better go." I don't know if the hands are all rising, but it was Lee Pemberton who sacked Kit McMahon from the headship of what was the Midland Bank and is now HSBC. And there should have been comparable action in the case of now my second point, question mark. My second point is simply very, very global, the situation. That's what's awful that it's so global, of this excessive accumulation of liquidity, the monetary base of government debt in the banking system, mostly the central bank. If you're looking for historical precedents, the only one that remotely resembles it is the situation at the end of World War II. And I think we have to try and get some lessons as to how to stop the kind of post-World War II inflation in unwinding this. I claim no magic, but one of the things that suggests themselves is that the high street banking system has got to be frozen. We've got to stop people using that monetary base for expanding credit. That's a big challenge. Question mark.
Thank you, Peter. So we have actually got another announcement to make at the end of this panel, but I just want to end by very briefly asking each of the panel members, I think this is relevant to the debate on emerging markets, whether they share Peter Oppenheimer's fear, which happens to be my fear as well, and I know it's part of Jerome's fear as well, that we do face considerable inflation in the Western world going forward as a result of extraordinary measures, as a result of quantitative easing. We'll start with Professor Muradoglu, just briefly.
It's a possibility, but I'm not afraid of it. There is a probability.
A probability.
There is a probability.
Is that probability greater than half?
Not to be, I think it's less than half.
Very good. Lord Lawson.
We certainly got to be vigilant. And there's certainly a risk, but I think this is one area where fact that the emerging world has emerged is a great plus. Because if it were just the Western world on its own, I would be much more worried. But we are now, in fact, one world. And there isn't this monetary problem in the far rapidly growing developing world. I mean, they've got inflation risk, everybody has inflation. They're always, but it's nothing like on the same scale. So now we are in one world. If we remain one world, if we will continue to have the globalization as the context in which everything happens.
You think we can absorb this massive monetary expansion?
I think with a little bit of skill and maybe a little luck too, but very skill more, I think we can. But it is a challenge, no doubt about it. And incidentally, one other thing, Peter, we're always good to see Peter. I mean, Peter is absolutely right about Northern Rock. The real failure of supervision. It wasn't the bank wasn't the supervisory authority. It was the LSA, which was asleep on the job. It was quite extraordinary.
A little smile from the chap from Bank of
You would have thought that even the most prejudiced supervisor would have realized that if one bank, a little bank, was increasing its share of the mortgage market, hung over this, because it had been quite performed at the expense of all the other mortgage providers. Maybe it was something risky there. I would have thought that they would have tumbled to that, but they didn't. Anyhow, I do believe that it is possible. But actually, this point throughout, if I may, if you talk about macro-prudential, in my opinion, if your micro-prudential supervision is good, then your macro-prudential problems are hugely diminished. And there is not the focus on it. Everybody is over macro-prudential, but it's the micro-prudential which is absolutely critical.
It's a Turnerism, right? It solves all the problems except the ones that matter.
Sorry, Gerard. Yeah, the question on inflation, maybe three parts. First, emerging economies, or a number of emerging economies, are currently out of favour because I think they're at the stage of the cycle where they have traditionally run into either inflation or trade problems. India is a good example, one or two others. So I think there is a near-term inflation challenge, but it's cyclical in many emerging economies. Second, continental Europe, I think, faces an immediate deflation problem. I expect the European Central Bank to ease rates. I think they'll cut again this week, is my personal view. I think continental Europe, apart from it suffers from the problem of the euro, which is fundamentally flawed, it suffers from a balanced economy paradox. Balanced economy paradox is that the policies that you want each individual economy to pursue in isolation are not the policies you want every economy to pursue. And if you do, as is happening on the continent, then you have a lack of demand with a deflation problem. So I think that's the immediate challenge, and it's probably the biggest near-term risk for the world economy. But the third issue, inflation. Yeah, I think if one looks at the UK, I think we have a major inflation problem. I think we've got rampant asset price inflation. The UK, as I was quoting in the Telegraph today, is one of the only countries in the world that thinks it can get rich by selling houses to itself. We need to trade, innovate, invest. And what we have at the moment is this lethal combination of cheap money, leverage, which is a key word in this book, and one-way expectations. I think we've got asset price inflation, and we need to be in house prices in particular. And I think the challenge is to stop that spilling over into the wider economy.
Jerome, last one.
Well, yes, I think we have two things that we didn't have certainly in the 1930s, if not after the war. And one is Keynes invented macroeconomics. And the other is we do have the emerging markets as the potential source of absorbing huge amounts of liquidity. But I think we have to remember that after the Second World War there was also a huge amount of financial repression, which was very successful. So, and I think in all the financial repression, by capturing domestic savings, doesn't allow that liquidity to go outside the UK housing market and to go into emerging market infrastructure. It's precisely that policy which prevents that. So we have, if you like, the role of the I talk about this briefly in the book, but I think as part of the current strategy is actually to bamboozle emerging market central banks and other savers to buy gilts too, maybe that tips the balance in favour of keeping the financial repression. And if they can be dissuaded of this idea, or if they persuade themselves otherwise, then actually that might tip things back in favour of the saver, and we might see a different scenario. But clearly we've got a lot of remembering to do. Ashok told us in the 1870s how to regulate banks. We just forgot. Anyway, I hope you all enjoy reading the book, and thank you very much for coming today.
Thanks, ladies and gentlemen, and thank you, Jerome, for asking me to chair the discussion. I'm very proud to be associated with the launch of this book and to be involved in such a distinguished panel, if I may say so. Fabulous. Just be careful how you write it. We just, before drinks, ladies and gentlemen, we do have one other small item on the dance card, if you will, and that involves the announcement of a deal subject to contract under which Jerome Booth's private office, New Sparta, will be buying an entity which is formed of two companies. We have the founders of the two companies in the room with us, and I'm going to ask one of them to speak briefly. We have Jim Hammond here, ladies and gentlemen, if you want to stand up, Jim. Jim founded Emerging Markets Direct in Telenews, and we have Ben Harris here, ladies and gentlemen. Ben is the founder and editor of a magazine, website, a news service called Business New Europe, and there are copies of BNE's monthly print magazine around. There are press releases on your seats. I first got to know Ben many years ago. We were fellow reporters in Russia and Eastern Europe. Ben is, like Jim, one of those rare beasts, a journalist, a writer who can actually read a balance sheet and has the guts to step over the field of play and be not just a critic, but to be an actor, a player, an entrepreneur, a creator of business. I think it's marvellous news that Ben and Jim and Jerome are putting together their talents and their resources to form a media organisation, BNE, in Telenews, in collaboration with New Sparta. I'm going to ask, ladies and gentlemen, Ben Harris to just give us a few minutes flavour of his magazine, Jim's business, and what the deal means to him. Ladies and gentlemen, Ben Harris, do you want to go?
Thank you very much, Liam. So I'd like to say, first of all, how pleased and proud BNE is to tie up with New Sparta and Jim, and I also want to acknowledge Nick Watson, managing editor, my co-founder and partner, without whom this would not be possible. He's everything that I'm not. My alter ego is good at the things I'm bad at. And together we've struggled to produce something that's worth reading. And the reason why, I've been doing Russia since 1993, and when I arrived in Moscow, there was nothing. There were no shops. We used to scour the city for kidney beans if we fancied making chili con carne. And it would be a hunt, and if you found them, then you'd buy 20 cans because you didn't know when you were going to see them again. And today, for anyone who's been there, it's more or less a normal country. Indeed, the UNDP upgraded it to high-income country last year, which puts it in the same bracket as Germany, France, UK, America. And so it is no longer an emerging country, an emerging market. It is a normal country with some huge problems, a lot of issues to work through. And if I want to pick up on something, core to what Jerome is talking about in his book about prejudice, this is the problem that under Yeltsin until about 2000, Russia was a fairly crazy place and just went hand to mouth IMF loans. Was very unstable, but from 2000 onwards, partly to do with Putin, partly to do with the oil price, it started to develop, it stabilized, and it started this path of growth. But if you read about Russia, and at the time I was the Daily Telegraph bureau chief, there are two Russias. There's the one which is run by the cabal of KGB spies who jail their opponents, who nationalize their companies and poison their enemies with radioactive sushi, which happens. And the other side, the other Russia, is the Russia where you now have an emerging middle class, which is anything between 30 and 60% of the population, where the poverty rate in Russia by their own poverty standards is now less than that in America, where incomes have gone up 16-fold. Under Yeltsin it was $50 a month, now it's around 900. If we translate that into American terms, then the average income has gone from $30,000 a year to $600,000, scaling it up. Which gives you a flavor of the transformation that the Russian people have experienced in the last decade and a half. And it's that second story. The first story you read about every day in the press. You know, Crimea, Ukraine, corruption, Gazprom, the Dutchess in the Black Sea, and what have you. But that second story about telecoms reforms, about the banking sector reforms, about Yandex, now the most valuable internet company in all of Europe, a Russian company. All of that story is largely ignored. And that's what BNE was all about. We take a pragmatic approach. This is an emerging market. It was an emerging market with very difficult problems that need to be worked through as a process. And we look at the opportunity for the investors. Actually, I'd actually like to chide the panel slightly, in so much as this was supposed to be a debate about emerging markets, and you spend nearly the entire time talking about Britain's banking problems. But that's partly, I think, the problem with the emerging market that's on our doorstep, is that there is not just a prejudice at play here, there's an ignorance. Because you're fed daily all of this doom and gloom about this evil empire across the way that just, you know, annexed a sovereign nation. Whereas actually the story is a lot more complicated. And it's not getting discussed. And I would argue that maybe part of Britain's problems could be solved by getting more involved. If you look at Europe, what is the most successful and stable country in Europe today? It's the Germans. Who are the biggest investors in Europe, in Russia? The Germans. Britain has about 400 companies working in Russia. Germans have 6,500. They're an order of magnitude. And I'm not saying there's a direct relationship between the health of Germany and its investment in Russia, but they're doing something right. Those companies are making a lot of money, and it's also part of the problem why the Germans are so reluctant to put sanctions on Russia, which is to say that Russia, not just Russia, it's one of the 4 investment banks. Turkey is equally important, Poland too, Kazakhstan and Eurasia are also important. But these are part of the solution, but people are not engaged. And again, I would say that's a lot to do with prejudice, which Jerome was talking about. Thank you very much.
I'd just like to add my thanks to Lyons for agreeing to be editor-at-large of the new combined entity BNE Telenews. Of course, I just want to tell you one little anecdote. When I used to work in Washington at the Inter-American Development Bank, I've got a very great friend, mutual friend, Davis, in fact, who told me when I was reading some magazine, weekly magazine covering global economic affairs, which will remain nameless. He said, "What are you reading that for?"
But the first word is the.
What are you reading that for? Do yourself a favour and look at the title of an article, then cover it up and write down what you think they're going to say. And if you get over 90% right, then ask yourself why you're reading it. And I did that, and I haven't read the said magazine for over 20 years, and the Unsaid magazine, and I have been delighted to find in Ben and James and Nick and the team, you know, a real opportunity to try and create really good quality on the ground journalism, which is going to, I hope, even spread further afield and help really address some of the prejudices that I address in my book. Thank you very much, ladies and gentlemen.